Hey everybody, and welcome back to the Teaching Tax Flow podcast. Here we're on episode 183, a topic you've heard numerous times throughout the years. We're going back, we're revisiting something, but under some new regulations that have been introduced. So the One Big Beautiful Bill Act, but we're looking specifically at cost segregation studies. So as always, Chris Picuro, welcome back to your own show, sir. And I'm going to let you go ahead and introduce our guest as well.
Well, thanks, Johnny T. I am so excited to have a return guest, one of our just favorite people in the Teaching Tax Flow community, Heidi Henderson from Engineered Tax Service. Welcome back to the Teaching Tax Flow podcast.
Hi, Chris. Thank you. Hey, John. Hey, Chris. I'm always happy to be here with you guys and talk about this kind of fun stuff. We've had some really great clients and projects together, and it's always fun to update the information for your listeners.
Well, we've got to update the cost segregation resume here. It is truly a blessing when I get to bring someone from our private CPA practice in to talk to the masses, to help educate, to legally and ethically reduce tax. People paying their lifetime. We had, the One Big Beautiful Bill Act come out, and now we know that bonus depreciation is at this point permanently 100%. And a lot of taxpayers, they don't realize that the Tax Cuts and Jobs Act was really reducing that bonus depreciation deduction. And it's in that yes, there are some new provisions out there. There's some new deductions. However, there's some bringing back of the old, which could be just as powerful. And
Yeah.
the lowest hanging fruit, the best ROI that I've seen, and we work in 89 different tax planning implementations right now, is a cost segregation study for the right taxpayer.
Yep.
Now, you are a returning guest. You're a great part of our community and our private Facebook group, but this might be the first time someone's met you and the team at ETS. Can you tell someone what is a cost segregation study and who should consider it?
Yeah. Oh, man. I could talk on that for a long time, Chris. I could go on
Yeah.
and on, so I'll try to make it brief. But, we are very unique. Engineered Tax Services, we're a licensed engineering firm. One thing I want to caveat before we dive into cost seg is that not all cost segregation is created equal. And that is one of the biggest, I think, misunderstandings of our industry in the specialty tax world right now. And that relates to, the term cost segregation is not one concrete deliverable. It has many definitions and it is interpreted in multiple different ways. So therefore, when you're working with a provider, what you get may be vastly different from one offer to the next. And so I want to caveat this whole discussion with the fact that it is vitally important as a taxpayer, and working with Teaching Tax Flow in this group, you're in good hands because they really understand all of the technicalities of this. But cost segregation, to make it in its simpler definition, it is the difference between taking a standard deduction and itemizing your deductions. A standard deduction would just be like, my kids, when they were young and they had to first file their tax returns, they're 18, 19, they're like, oh my gosh, I have to do a tax return. Standard deduction, easy peasy. But you start to have your own business, and maybe itemizing can generate additional expenses so that you have a larger deduction. That is what happens with a building. The typical CPA is going to take your standard deduction, which is straight line. After land, commercial properties are 39 years, residential are 27 and a half years. When we itemize the deductions, we just simply appraise everything that you bought. And we say, we know that you did not simply buy a building. You bought refrigerators and cabinets and carpeting and landscaping and some sprinklers and all of the things. So it is a report, an inventory of everything you purchased and what you paid for that specific item, which then subsequently allows you to apply those into different categories, which then qualify for bonus depreciation, and you get a significantly larger deduction. So that's kind of the simplified explanation.
Well, I appreciate that explanation. I love the analogy as usual. And I want to say this. I say this to people all the time. You can go to 10 CPAs or enrolled agents and have your tax return prepared and get 10 different results, and they might have 10 different ways of doing it. So a cost segregation study, I think it's super important to understand, it is not a commodity. It is a project, and whoever you have leading that project's responsible for getting you the best result possible within the rules.
Yeah.
Sometimes people think that, well, again, cost seg is not a commodity; it's a project, and there's a big difference. And that's why we have you on, because I love you guys, and you guys do such a wonderful job for our community.
Thank
Yeah,
you.
when you buy real estate, inherently there's personal property within that real estate, and this is the process of pulling that out,
Mhm.
and giving you a better result. What type of properties are typically great candidates? And I know I'm asking you a loaded question, because
Yeah.
it's not just the property, but it's the activity or taxpayer that makes it a good candidate for a cost side.
You're exactly right. There's 2 sides to the coin when we look at cost seg. I have people ask me all the time, "Does my property qualify?" Well, any investment property qualifies. You can apply cost segregation to any type of investment property, a residential property, a rental, a short term, a long term, a commercial building, office, self storage, mobile home parks, you name it. Cost segregation is an accounting method. It is allowable, it is drafted and outlined in the IRS tax code as an accounting method we use for how we depreciate real estate. So, totally applicable and applies to all. The highest producing properties are things that have more personal property, more fixtures than others. So, a warehouse, a distribution facility is going to have less immediate depreciation than, let's say, a mobile home park, which has very little infrastructure. Actually, it's all land improvements and asphalt and landscaping and fencing, and that's all actually personal property. So we look at that. Residential properties, short term, long term, multifamily, those typically have pretty good results. After land, with just the building cost, we're typically able to shift about, you know, 30%, 35, sometimes as much as 40%, depending on the finishes inside. But it's a pretty compelling number when we look at that. Once we understand that cost segregation itself is applicable to any property, then the secondary analysis, and this is why I love working with you guys. The secondary analysis is you as a taxpayer. What is your activity or involvement in the investment, in the real estate itself? Because then it determines whether it is considered active or passive. That means active offsets any active income, including a W 2 wage, which is what most people are after. And passive only offsets other passive income like rental income or other investment income. And so there are limitations. Someone's ability to use it as active or passive depends on activity. So your CPA needs to evaluate activity. I, as a cost segregation professional, evaluate the building. So that is a designation, sort of a line in the sand sometimes that our clients really struggle with because they want us to consult with them on material participation and the short-term rental loophole. That's where you guys come into play. We deal with the building itself.
Absolutely. They're complementary analysis. And the cool thing with cost segregation study is I love Monopoly. No one will play Monopoly with me anymore. I'm a pretty nice guy, but I'm vicious when it comes to Monopoly. However, one thing in Monopoly, the reason I'm mentioning it is Monopoly gives you, remember, the little, you got chance and you got community chest and you got the get out of jail free card. And why that's important is that a lot of taxpayers don't understand that the cost segregation study, now sometimes it's a no-brainer and we're going to get it done right after acquisition. Especially if you have a building, let's say that there's an acquisition and then a build out, but it doesn't have to be done before the end of the year. There's a lot of times that the cost segregation study can be done, as long as it's done before the tax return is prepared. It could be counted for that previous year, or it could be done for previous years, like 2021, 2022, 2019. And that's part of looking at someone's depreciation schedule as a tax professional and determining if they're a good candidate. And that's one thing you mentioned, as far as a cost segregation is an approved method of accounting. I'm going to reinforce that, because in the situation where we look back and we look back and we say, hey, this person put this property into service in 2021, they went straight line, they can take the deduction and it'll be beneficial for them in 25 to take it. We go back to get technical, work with the ETS or another cost segregation study company. But again, I love you guys. And you say, if you would have done this before, get out of jail free card, this would have been your deduction. You only took this amount of deduction. So we're going to give you the difference on your 25 return. That's called a 481A adjustment. We file what's called a 3115 with the IRS. Why am I getting technical? Because my point is, we are alerting the IRS that we changed our method of accounting. The IRS automatically approves that. It's on the automatic approve list, meaning they understand it. This is not doing the cost segregation study alone is not increasing your audit risk at all, in my opinion. So
Yeah, that's a huge comment. Yeah, because I get asked that question all the time, especially when people look at the number. Because if you have a property that's got any significant tax basis, $500,000 or more. By the way, we're doing cost segs on $100,000 buildings, but when you get into something that's 500,000, the amount of depreciation and tax savings is surprisingly large. And so most people then are like, number one, this is too good to be true. Number two, how did I not know about this? This is crazy. And number three, surely I'm going to get audited. This is super scary because it's so much benefit. It's like a little bit, if you're not familiar with it, it's kind of shocking. But there are reasons behind it. We do a lot of education on that as well to explain there's a reason why this is in the tax code. It actually, when you understand that personal property does have a reasonable, useful life, when you really think about it, as one simple example, if you buy a short-term rental property that has a stove, a dishwasher, a refrigerator, and a washer and dryer in it, and they're included, and the property is 10 years old and the appliances are 10 years old, there's a probable, reasonable assumption you're going to have to replace those appliances. But you bought that property. If you don't do a cost seg study, you will depreciate those appliances for 27 and a half years. And there's no way they're going to last that long.
not even
And
my
so-
parents' fridge lasted that long.
Yeah, exactly. So that's what's amazing is the cost segregation. It's not a tactic. It is there. The IRS says it's actually a preferable method of depreciation because it's actually more accurate. You get a massive tax deduction, but it is because you should take a very fast deduction for those appliances because you will likely need to replace them with new ones, which then also now are new fast depreciation. So I like to kind of help people wrap their heads around that concept because it does sometimes feel like it's some type of a loophole or a strategy that they're going after that's really aggressive. But when you understand the methodology behind it, it makes all the sense in the world.
When we talked about, when it might make sense, from a tax perspective, when we have someone that can benefit from the deduction immediately as a non-passive activity, or that's a pass, it's funny because I would argue for many people, especially higher income people, maybe they're in a high marginal tax rate, that a cost segregation study isn't a terrible idea to create passive activity losses, right?
Yeah.
Because maybe they have a gain on another property that they can offset. I mean,
Mhm.
can you imagine someone that's in a 40% marginal tax rate, including, maybe they're in New York or California or something like that. And you say, well, look, you could buy this property. It's going to cash flow positive and you could segregate the cost. And for the next 12 years, you're not going to pay tax on this income because you have this
Mhm.
carry forward. Not all
Yep.
tax planning has to be this year. It's legally not to reduce the tax pay in your lifetime.
Yep.
That being said, there is something cool that is available and that you've seen in practice also where some timing's important. So sometimes someone we had a client in our private CPA practice, and I want you to touch on this, is that someone might have had a home that was a long-term rental property, and they want to start getting more involved with it, and they actually converted it to a short-term rental, and they were operating it and doing the listings and communicating with guests. At that point, they might want to do the cost segregation study in the year they have that, what we call material participation. So is that possible for someone to, kind of expanding on, you don't have to do it in the year you acquired the property?
This episode is sponsored by Wealth Builders Mortgage Group, powered by Movement Mortgage. one of the top mortgage teams in the nation and a powerhouse in the real estate investing world. With over $1.1 billion in closed mortgage volume and more than 3,000 investor deals under their belt. They don't just talk the talk, they walk it. Their team specializes in helping short-term and long-term rental investors scale smart with customized lending strategies. They offer all STR loan products, including second home, investment, non-QM, bank statement, asset-based, and HELOCs. They also offer all primary home loan products too. Whether you're just starting out or expanding an existing portfolio, their unique Path of 10 strategy is designed to help you move from a 9-to-5 job to financial independence. If you're looking for a lending partner who truly understands the investor mindset, visit wealthbuildersmortgagegroup.com and start building your roadmap today.
Yeah, I mean, you bring up a couple of amazing points, because you're right, we can apply a cost seg study retroactively. I appreciate you bringing up the fact that even if it's passive, it doesn't necessarily mean that's a bad thing. A lot of people say, well, I don't qualify because it's passive. Well, I mean, I am not technically a real estate professional, but I have real estate. I do cost seg on every one of my properties. Those are carry forward suspended losses that I carry on my tax return. It offsets any other investment income. And at the point that I sell a property, it will be deployed at that stage as well. So the suspended losses are like, hey, I got this, little golden nugget here sitting here that I can deploy when it's needed. In a perfect world, it offsets active income. And in that case, you're exactly right that if a taxpayer has a change of activity, and maybe it was passive, so they've never done cost seg, they didn't need the additional deductions. Now something's happened, maybe they're retiring or they're reducing work or they're going to part-time and they're getting more active in the real estate side. Or 1 year over a next, they decide to try short-term rentals and they're managing it where they weren't before. And they're like, hey, I want to try this out for a year. All of a sudden, it's active. And that is a perfect opportunity to deploy a cost segregation study on that for that year, for that tax return, and then it would actually trigger as active.
I mean, we have clients in the private CPA practice that like projects. So they'll buy a short-term rental property. They'll meet what's called the material participation test. They're basically putting their time into it, get it up and running. Maybe they bought it in, September, really put their heart and soul into it, got it going, have some bookings, kind of get it moving. And then in March of the next year, they move it over to a property management company and then they do it again. So the point is to meet some of these thresholds, you only have to meet it. It's a year-to-year test. And what Heidi's saying is pair the cost segregation study, if you're looking for that immediate deduction, with the year that you meet the test, which you see, that's planning. You have that flexibility.
Yeah.
So yeah, we appreciate it. Yeah, that's cool. With One Big Beautiful Bill Act, let's remember we are in that 100% bonus depreciation era. As a wrap, though, I do want people to be aware, and maybe you could touch on this, is the year you placed a property into service is really the most important factor when it comes to the deduction.
Yes. So that it gets okay. This is where we get technical,
It's tricky, right?
the One Big Beautiful Bill threw a little bit of a wrench our way. Now we're getting past it, but we're still running into it a little bit right now because we're in the middle of the 2025 tax season right now. But ultimately, what the One Big Beautiful Bill did, extended 100% bonus depreciation. However, it threw a little wrench and it said it only applies to a property that was both purchased and placed in service after January 19th of 2025. So we had many investors who bought properties in 2024, got it set up, got everything going, or they were building something, and then it actually got placed into service after January 15th or 19th. The other scenario we see a lot, we have a lot of people who have their primary home and they convert that to a rental. So they decide to move out. They're going to convert their primary home now into a rental property, and they'll start using that. The same triggers because you actually purchased it before that cutoff date and placed it into service later. So it actually does not qualify for 100% bonus under that new subset rule that we see. So just be aware that's a little bit of a little catching point. We have a lot of people who have that situation, their primary home converted to rental. and they're sad when they realize that they qualify for 40% bonus instead of 100. So that will continue to carry if you purchase the property prior to 2025. But other than that, anything now after that January 2025 date, purchased and placed in service, depreciation does start on the placed in service date. So that does also ring true and is very important for investors to understand if they're looking for a particular year. So let's call it 2025. They want to make sure they have the property placed into service before December 31st of 2025, or in this case, 2026, so that they can apply it to that particular tax return. So that gets into, what is considered placed in service? Was it ready for rent? Did they actually have rental activity? And what has triggered that? So that's always something, again, to make sure is well understood when we're utilizing the depreciation.
Well, guess what? If you are watching this on YouTube, or if you're listening on any of our platforms, you're in good hands. First of all, you could be part of the Teaching Tax Flow community in our Defeating Taxes private Facebook group. If you're not sure if you have some questions about cost segs, just post in there. You could even post anonymously. Talk to your tax professional, figure out, is the activity passive or non-passive that year? Then we could talk to a cost segregation study company like ETS. They're going to do an analysis for you to determine, does this make sense before committing to the study, so you have those tools in place. Don't go about this yourself. We talk about building your personal board of directors, and again, Heidi, we so appreciate you joining us here, and now we're refreshed with cost seg studies and ready to rock and roll moving forward.
Absolutely. Let's get to work.
Oh yeah, and now that I'm back in at the end of your guys' discussion, I've been over here writing stuff down again. Heidi, I know we've talked about this, I think, in a couple podcasts and multiple discussions, and every time we do talk about it, I'm sitting here writing things down, and I'm glad that you ended with the caveats, right? So not everything is dropped 100% into the 100% bonus bucket, because I'm sure a lot of people are out there thinking like, oh, well, of course I got it because X happened, I'm good. So that was a great ending.
Good. I'm glad. And you know what? I will be perfectly honest. We've had a couple like head-to-head but discussions with some of our CPA partners as well, because this was not something that got caught. It is literally one word that was added in as a change. So this is really important for CPAs and tax advisors to understand as well as investors.
Excellent. Awesome. Well, we'll definitely have you back here again, and then we'll always ping you with some questions. And as Chris mentioned too, is everybody that's listening to this or watching this, we're going to drop some resource links here in the show notes, as well as go back and listen to some of these other podcasts. I think there's a lot of, especially this topic, there's a lot of things that lead up to it. Now, obviously, this is not the entire story. We can't tell you every single thing about the process with cost segregation studies. So go listen to it. We're here with more information coming up next week, as always, here on the Teaching Tax Flow podcast. Have a great week.
The information in this podcast is educational and general in nature. It reflects the opinions of Teaching Tax Flow and does not take into consideration the viewer's personal circumstances. It is not intended to be a substitute for individualized financial, legal, or tax advice. Consult the appropriate qualified professional prior to making any decisions. Securities are offered and supervised through Cabin Securities Inc. member, FINRA, SIPC. Investment advisory services are offered and supervised through Cabin Advisors LLC, an SEC registered investment advisor. Chris Picciuro is a registered representative of Cabin Securities and an investment advisor representative with Cabin Advisors LLC. Teaching Tax Flow is an independent entity and is not affiliated with Cabin Securities or Cabin Advisors.